So in our annual accounts, we've referred to it as a year of positive change. And the reason why we've done that is obviously the manager was acquired by Patria Investments from Aberdeen. So there's been a change at the manager level in terms of the ownership. No change to the personnel managing the trust or the strategy, but there has been a change there. And that's meant also the trust changed its name from Aberdeen Private Equity Opportunities to Patria Private Equity Trust, or PPET for short. But it's not just about things happening at the trust level or the manager level. The portfolio as well, we did a large secondary sale. We've increased the debt facility from 300 million to 400 million in size and pushed out the maturity to February 2028. And generally we've seen cash flows and exits and activity increasing in the second half of the year, and we expect that'll continue into 2025. So there's been a lot of positive change and momentum with regards to PPET during the year. Now, if we focus on 2024, it's been a positive year in terms of the share price. So the share price total return was 24.9% during the financial year 2024. So really positive momentum there. And that was driven by a buyback program that the board implemented in January 2024. At a portfolio level, the NAV total return increased 2.4%, which is behind our sort of long-term run rate, sort of annualized NAV total return of 14.8% over the last 10 years. FX was a big detractor. The appreciation of sterling versus euro and dollar, which most of our investments are denominated in, that had a real headwind effect on the portfolio. So if you actually look at the portfolio at an underlying level, the portfolio return in local currency was 8.8%, which is broadly in line with what we've seen over the last couple of years. That's generally been around that sort of 8.8 to 11% range in local currency. But what's pleasing for us was that at an underlying level, we're still seeing strong earnings growth. So if you take our top 100 companies during the year, the revenue growth was around 12%, and the earnings growth is around 18%. And the top 100 companies equate to just shy of 2/3 of the portfolio value. So we're seeing good growth at an underlying level. We're seeing recovery in terms of activity and exits. And the exits we did see in the year, the full sales, the natural full sales, I would say, they were at a 26% uplift in terms of valuation when compared to the valuation 2 quarters prior. So we're still seeing those uplifts when a company is sold, which is really, really positive. So yeah, there was great momentum there in the portfolio level. Cash flows, as I said, have improved. If we look at the overall cash flows, distributions, realizations, they outpaced the drawdowns that came from the portfolio. So we're in a net positive cash position again after last year where we saw a sort of cash negative position. So that's linked to the recovery in private equity activity. And all of that points to a pretty optimistic view on 2025. As I said, the activity really came through in the second half of 2024. We've seen a lot of transactions signed in the latter part of 2024 that will close in 25. And generally the sentiment in private equity is very positive right now. We've had obviously a quieter couple of years, but there's a general consensus that 2025 will see an uplift again in terms of private equity activity, which has positive consequences for cash flows and NAV growth. Deal flow is increasing, and we have seen it increase in the second half of 2024. We do expect it to continue to recover into 2025, and absolutely it has a positive impact, or it should have a positive impact on PPET. The reason for that, as mentioned, is that we really see that when activity levels are higher, we see more exits in the portfolio, more businesses that are sold to either a financial buyer or a trade buyer, possibly even IPO'd. That results in more cash coming back to PPET. And when that's the case, we typically see exits happen at an uplift. Over the last 10 years, that uplift's been around 25% in terms of valuation compared to the unrealized valuation 2 quarters prior. So more activity means more cash back, more exits, and typically those exits at an uplift, which means that there's a tailwind to NAV growth. So increased levels of activity in private equity is typically a good thing for private equity trusts like PPET. As a reminder, PPET's been around for over 20 years. It was established in 2001. From its inception, it was focused on private equity funds. Until 2019, we introduced direct investments into the investment objective. And the reason why we did that is that, well, firstly, we had a team that had been making direct investments for years. It seemed a logical sort of progression for the trust. But direct investments have a major advantage over funds insofar as they don't charge the same level of fees. And typically, a lot of co-investments specifically have no fees or carried interest attached to them at all. So they're at no cost at an underlying level. And that compares to funds where management fees can range between 1% and 2%, and then there's a carried interest on top related to performance. So building this book of direct investments, hopefully a quality book that performs well, has the potential to really outperform the book of funds because of that lack of fee drag. But in addition, it's not just about fees. It obviously gives us more control over the balance sheet and investing the trust's cash, because funds are typically a commitment where then the commitment is drawn over 3 to 5 years. So the cash, you're less of control around cash, whereas with direct investments, you make that investment up front. In addition to that as well, it just gives us more control over portfolio construction as well, what sectors we like, what subsectors we like, what geographies. So we can just position the portfolio a lot more proactively via direct investments. As we sit today, direct investments equate to around 26% of the book. As I mentioned, they were introduced in 2019. So we've grown that book to 32 companies. And what we'd like to do over the short to medium term is grow that book to around 35, 40 companies and about 30% of the portfolio value. I think we'll have a consistent investment strategy and investment direction. But what the increase in the facility does is just gives us a lot more flexibility. So we've increased the size of the debt facility from 300 million to 400 million and brought in a new lender in the form of Santander. And we pushed out the maturity as well to February 2028. So that means now between cash, deferred consideration that we expect to receive in the next 9 months from our secondary sale, and the increase in the debt facility, we have over 400 million of resources that we can use for investment purposes or corporate purposes. So it just gives us a lot more flexibility. And as mentioned earlier, as we move into 2025 and we think it'll be a busier year and there'll be a lot of interesting opportunities, it means we can be a lot more on the front foot and a lot more proactive and potentially have a slightly higher investment year than the last couple of years.